So I'm Victoria. Sarah just said I'm the organizer of European Blockchain Convention. Today, we have a very, very exciting panel in front of us. We're going to talk about institutional grade crypto products. We're going to try to understand what is it investors are looking for. Do they feel more secure? How would we even start building products from scratch today if we could? So for that, I would like my dear speakers, I would like Eric, Theodore, Jörg, and Adriano, and Marco to just shortly say a few words about yourself, and then we will dig straight into the questions.
Yep. Thanks for having us. First of all, I'm Eric. I'm Managing Director of Crypto Finance. Crypto Finance is offering crypto custody and trading for institutional investors, not retail investors, but only institutional business. We are one of the first companies in Europe who received the MiCA license. We are 100% owned by Deutsche Börse Group, and our bestseller is a bit giving infrastructure, licensed infrastructure and trading services, custody services to banks who want to offer something to the end investors.
Thank you.
Good morning, everyone. Theodore, one of the co-founders at D2X. We're a MiFID-regulated crypto derivatives exchange that just went live in December, regulated as an MTF in the Netherlands. Go Europe. We have a pretty simple value proposition. It's to build regulated market infrastructure in a 24/7 format for derivatives. An important feature in what we do is off-exchange collateral solutions, which we do in partnership with tier 1 banks like ABN AMRO.
Good morning, everybody. I'm Jörg, MD for Tech Product and Operations at Finoa. Finoa is a licensed crypto custodian and staking provider based out of Berlin/Potsdam, 5 years old, and pretty much a global player. Our customers are from everywhere in the world, institutions, VCs, family offices, asset managers, and so on, served by us on both custody and staking.
Adriano Bertini, Head of Strategy for Ledger Enterprise. How many of you are familiar with Ledger? 7 million customer, 20% of the total crypto assets secure with our product. We also have an enterprise solution, which is the B2B arm. We have the standard custody technology product, but also we launch an off-exchange trading product, which is what we want to talk about today. And really excited for this panel. Thank you.
Yes, good morning. I'm Marco, MD of Bullish Europe, the European arm of Bullish Group. We are one of the largest liquidity provider in crypto, probably number 3 in the world at the moment. Serving only B2B clients, so institutional clients mainly like broker firms, exchanges, institutional clients of all kinds. And I'm really happy to be part of this panel today. Thank you.
Thank you. Okay, so as you all know, institutional investors in crypto did not exist many years back. We had a few. And also the view on crypto was like, okay, this is just pure speculation. This is very dodgy. But we are not at this point any longer, thanks to regulation, thanks to the products that you're building. So my first question is, okay, when you're speaking to institutional investors nowadays, not a few years back, what are they looking for in your different firms, in your exchanges, brokerage firms, wallets, and custody providers? Eric, do you want to start?
Yes. Indeed, it has luckily changed because many years ago institutional adoption was not very, very advanced. And that has massively changed for some reasons. First of all, obviously regulation, a bit boring topic for some, but it has massively changed so that there's actually within banks and institutions not really an excuse anymore to enter the market. So we heard for many, many years there's a regulatory uncertainty. That is not the case anymore. And you see this in various departments of a bank. The excuses are getting less and less to actually enter the market, and the pressure from the client side is getting bigger and bigger. And that leads to actually an increasing adoption of institutional investors. What is also interesting, what we can see, and that has also changed a bit, is when we talk to banks who actually looked at this many years ago already, when they were looking left and right, if there are some, for example, custodians who are really offering an institutional solution, there were none. There were no infrastructure providers many, many years ago that were institutional grade. There was also a long time before Fireblocks became big and so on. And actually, Crypto Finance started the same. We were actually starting in asset management, looked for a custodian left and right that fulfills our requirements, and there was just none. There was no licensed custodian out there. There was no infrastructure provider that could fulfill these needs. So we started building up our own solution that is fit for our purpose, turned out to be also fit for other institutions and serving their needs. So what we see, a lot of banks started initially with building something by themselves because there was just nothing out there. That has massively changed. Now there are big institutions, there are solutions that really fulfill also the compliance needs, the risk needs and so on of big institutions. And you see more and more in the discussion that it's shifting a bit away from the necessity of banks to run and operate their own infrastructure to actually outsourcing this to a sub-custodian who is licensed for this, who is taking all the operational burdens away from them and so on. And that is one major shift we see. Yeah? The reliance of institutions also on big other players in the market to not necessarily do everything by yourself.
But just quick question, Eric. Also, now you're talking about the European banks, that they have no excuse. Now at least they have their regulatory framework. But still you see some European banks that are much quicker and others that are still not really doing much. Why?
It very often boils down to the management level and if they like crypto or not, or if they have kids who push them to integrate crypto or make them curious about it. It's really very often the case. So we see this, and also in Deutsche Börse. I mean, I was, before working for Deutsche Börse, trying to push this also for years and years. And sometimes it's just a timing issue, and sometimes it's just an issue that one board member in a bank just doesn't want to have it, and it's as easy as this sometimes, and we see this with some board members who have kids, and the kids are showing them how it's working. They get more curious and so on, and when there's a top-level decision to go in the market, they will go in the market.
No, but yeah, wait. So last night I had a good conversation with Anja from, where are you? Are you here, Anja? No, about like some Nordic banks. I'm from Denmark originally, and they've been doing something behind the scenes, like for maybe 8 years, but that's just it. And then the other day, so I'm based in Spain, I saw, which was good news, that BBVA got the green light from the Spanish Central Bank to now offer crypto trading services, and I'm like, oh, good, because Spain is usually, I don't know, really slow. So, but okay, so there is these things going on internally. Okay, guys, can we get some more answers?
Maybe I can add to that. So from our standpoint, what we have seen is a strong request to find a way to unlock new liquidity in the market and new trading opportunities for their client from the institutional investor perspective, especially on the buy side. And what we have focused in the last, let's say, year and a half, is to reduce counterparty risk for them, because that's what we can do as Ledger, because we are focusing on security. So if you can secure the collateral assets when they're trading, then there is less counterparty risk. Why is that important? Because reducing counterparty risk will then make them more comfortable to entering new markets and new liquidity that currently they cannot access. This is really important. Like from our estimate, is 20 to 30% of liquidity that currently is not grabbed because the risk towards certain liquidity provider is too high for them. So that's why we built off-exchange trading. We'll talk this afternoon more about TradeLink, our off-exchange trading technology. But we said basically, like, with the security that we have, with the level of security that we have with our product, can we basically bring down the cost of counterparty risk? And this is something that they come to us, on a regular basis. So I don't know if you guys have a similar experience around that.
Yeah, somehow, obviously, we agree on that. I think coming back to the main question, the regulatory framework is actually what forced literally everyone in the business to get educated, to develop themselves, and big institutions like...
In the business? Where do you mean?
Yeah, the crypto space, crypto business per se, because if we are talking about major banks, you just mentioned Spain as an example, we have other major banks even here in Germany who acquired a license in crypto, and they have the need to have a counterparty which is licensed as well. So from that point of view, the license framework just opens up doors into the institutional world. So the crypto business has grown up from being more retail focused to now moving into institutional business and the institutional money flows into the market.
But still, I guess we are still, maybe before we were in like kindergarten, now we're in preschool, so it's still early, right?
Kind of, yeah.
I mean, there's a long way to go to reach the institutional space for crypto. I mean, product-wise, infrastructure-wise, to be on a university level.
Yeah, I totally agree. But nevertheless, the regulatory framework is actually the door opener and the key to get this development started and this educational path started for all of us sitting here.
I think your point is interesting on the regulatory frameworks, but there's, I think, a very different answer or perspective to give if you look at derivatives markets versus spot markets, because the truth is we've had regulatory frameworks for crypto derivatives for years, right? The CME started in 2017 with their products. And I think to your point on liquidity, I would say crypto and crypto derivatives are relatively liquid today already, but I completely agree with you that when it comes to risk and security, there's a long way to go. At the end of the day, from an institutional perspective, there's mostly two prerequisites, which are regulatory compliance and risk. But on the other side of that, you need a good product. And what we see today, if you look at market infrastructure, is there's always this dilemma of either you have a regulatory compliant product that's quite robust from risk management standpoint, but the product itself is not that relevant, or vice versa.
Yeah, I think, sorry if I can quickly, I think there's also a problem of the new digital asset, the new asset class, which is digital asset. So it's a better instrument. Whoever owns it has full control over it. There is no recourse. There is no support service that you can call, right? So that's what we want to address, because we think that that will have an impact on the overall risk of risk exposure and overall risk in the industry. So if you're able to control that part, if you have security of collateral assets cryptographically, then you can lower the overall counterparty risk, in addition to everything related to regulation you guys just mentioned.
Coming back to your question once more, Victoria, you said institutional adoption is driven by regulation, which is quite interesting, right? Looking at the crypto space, which was built with a decentral idea in mind. So now finally institutional adoption is happening because regulation picked up globally. And it's interesting from a meta perspective to see how only within 15 years, a space which was completely decentral built now starts moving because regulation kicks in. For us, one of our main customer groups is crypto protocols, crypto foundations. So the most native crypto players you can imagine, and still they are coming to a regulated crypto custodian to store their own tokens, because that's the way you do it today, if you have like large amounts of money to be stored.
Yeah, we're just gonna close the curtains. I think, but it's interesting, yeah, I mean, like the whole space started as completely decentralized. And then now you mentioned that you work with a lot of foundations, that's like some of your major clients. But I think it's also interesting, just a little side comment, to see now foundations diversifying like their treasuries and investments, not just into crypto, but like getting maybe into like a BlackRock product through some tokenized thing, you know? So they are now, the true DeFi players are now also investing in TradFi products through blockchain. I think it's also quite fun to see, you know.
Also because DeFi is still hard to access, right? From a regulated perspective, if you store on a regulated site, getting into DeFi is always a little bit difficult.
Thank you. Well, Marco, all of you actually already mentioned a little bit like the regulatory clarity, but maybe just, I mean, in terms of regions, if you could just go for one region. I mean, now we are based in Europe. This is what it is. But is there any regions regulatory-wise that you would prefer? Or is it Europe?
Well, that's easy to answer. As we're set up globally, we started collecting licenses all over the place. Europe obviously was the first major license we acquired last year here in Germany. In February this year, we acquired the license in Hong Kong for running a trading venue there. Our origination actually from the tech perspective, and our first exchange was set up in Hong Kong. And now that Trump is pro-crypto as well, we're about to enter the US as well on a license perspective. because, as mentioned earlier, I mean, our target group are institutional clients nowadays as well, or even more than in the past, and therefore you need the license wherever you can get it.
But which one is like the preferable structure, if you could?
And it depends a little bit on where your client sits and what you're offering. Again, in Hong Kong, it's running a trading or an exchange, it's an exchange license. Here in Europe, we choose the broker-dealer setup, so crypto custody and broker-dealer license, because the European market is actually more based on the crypto dealer business per se, and in the US it's pretty much the same.
So for Finoa, we are pretty surely more well known across outside of Europe than in Europe. Still, we are a German player with a German license. Europe is just not big enough to run our business successful, so we need clients from everywhere. And we see how MiCA is good in Europe, but also restrictive for the Americans, the Asians, and so on, because we cannot offer everything which they can buy over there. So also for us, the way is to go for multiple licenses across the world to be able to offer to our customers what they are used to get in their regions under their jurisdictions and licenses.
I think this question is harder to answer since a couple of months. I would have had a better answer late last year, I would say. So MiCA, while it's absolutely not perfect and sometimes really overburdened, and some parts of MiCA, from my point of view, are also a bit useless. However, it is a good and stable framework, and I would have said actually Europe, from a regulatory certainty, is the place to be at the moment, and you can obviously address also with one license a quite big market. US was not that advanced and is not that advanced. However, now with the change of the administration, they will pick up massively fast and probably come up with a easier regulatory framework to comply with. So now it's a bit hard to say, to be honest, if MiCA is still as good as a potential American regulation will be. But still, it's some other jurisdiction look at Europe a bit with envy. Also, I would say from the UK perspective, sometimes when we were at EBC actually in London, I heard this very often, that they see Europe moving so fast in this topic and they are basically nowhere. So I would still say at the moment Europe, but probably the US going forward.
Yeah, maybe if I can add to that, I've been spending the better part of the past 4 years working on license applications and so on, and I'm sure a lot of people in the room also felt that pain. I do think, once again, the answer is probably different if you look at derivatives or spot, but I do think, and to echo some of the points that were made, Europe is, I think, for once in a great position. MiCA was a great initiative, right? It's not that often where the leaders and financial innovation, let's say, there's this element of stability which is highly important. And the truth is, when you look at regulatory frameworks like MiFID and so on, you do have lots of equivalences, exemptions regimes that you can leverage, which means that it's not because you're licensed in Europe that your market is, your audience is constrained to Europe, right? Having a European base, in our case, for example, we have a very global reach. So I think we have great infrastructure, we have good regulatory frameworks that are clear, we have big institutions that are active in the space here. I mean, we have some of the biggest prop trading firms, for example, right? And they represent a large percentage of the volumes we see in crypto. So I think Europe, for once, has all the right, let's say, cards to win this time.
But do you agree with Eric that most probably the US will present a better regulatory framework?
No, I don't think so.
No?
I don't think so. I think, the truth is, no one is reinventing the wheel with these regulatory frameworks. If you look at MiCA, it's largely inspired from MiFID. I think the US will do something very similar. This discussion that we have sometimes around this regulatory framework being better versus this other one, to me, it's a bit of a non-issue, or at least it's not the true reason why people choose a jurisdiction. I think people go where they can get a license, and then you have the question of whether the local market is big enough. When it comes to the US, it's of course the largest capital markets by far, so that's a big advantage that they have, but we do have a very sophisticated market here as well.
Jörg, you just did a strange face, like there was something you didn't agree on.
No strange face meant.
Okay, I mean, you're allowed to not agree, you know that. Okay, thank you. So my next question. So institutional crypto custody has grown, right? Or at least, institutional interest in crypto custody has grown, not just from institutional players like banks, but also like DeFi players with large amounts in crypto have changed. Like, I don't know, I mean, even like, OGs with their huge, portfolios are now like, okay, let me get my, I don't know, my crypto custodied in a bank or whatever, you name it. So why is that? I mean, we talked about regulation, but is it also because of the tech, the insurance behind? What is it? Is it just regulatory? I mean, is it the regulatory framework that's the answer, or is there more behind?
So I think, first of all, interest in crypto has increased. And then if you want to go into crypto as an institution, you need to ask yourself, how do I store this? And then you come to the conclusion that the ledger USB stick in your wallet and in the bank is maybe not the best idea as an institution. Then you come to the conclusion, okay, I need somebody professional managing this with all the access rights, security, and so on. And that's why you end up with qualified custodians, regulated, which offer services as you need them, and with all the fallback mechanisms, proper processes, IML processes, etc., PP, all this is driving players to qualified custodians.
Yeah, if I can add, I agree with you. I think technology was the main driver, and specifically security technology. We think we had a big part to it, and the market kind of, show us that, giving us, as I say, around 20% of the total crypto assets secure with our product. The improvement on security in the digital asset market, it's even more important than any other market. And the reason, as I mentioned before, is that whoever controls the master key to the wallet has access to the funds. Like, there is no recourse. So very early on, and last year we did our 10-year anniversary, so it's been the longest in crypto of any company. We focus on the security aspect. We have a dedicated team called the Donjon who does penetration testing day in and day out. I think we are one of the few, if not the only one, having that. So we give that to the industry to make sure it's more secure. And to answer directly your question, that is translated to people being more comfortable deploying assets.
So it's the security aspect, not the regulatory framework.
I mean, the regulatory framework helps because you want to do things compliant. And if you're an institutional player, that's the only way you can do it. So regulation definitely helps, and regulation improved massively. But the speed of growth of technology that we have in the last, 10 years is, incredible to any metrics or any measurement.
So why did the huge Bybit hack happen a month ago?
That's a very good point.
2 months.
So, which leads me to the second point, which we should not be complacent as an industry.
We should not be what?
We should not be complacent as an industry, meaning we should not think that security is stale. Security is always evolving. And there is this tendency across the board in the industry. We think that security is a binary choice. Either we are secure or we're not secure. But security is a market that moves with basically the hacking market. And the market works like any other market, meaning how much does an attack cost versus how much money I'm going to make from that attack. Mm-hmm. That's why we invested in a dedicated team to prevent this, to be a step ahead. Because that's the only way that we can make this market secure.
And then just another question about this hack. Now you mentioned, okay, the technology, but do you think also, I just thought about it the other day, like, so all these hackers from North Korea, yeah, they know better everything around them in Asia. We always know what's going on around you. So do you think in that case, Europe is a little bit more safe as an exchange?
No,
or?
not at all. It's okay. A global market. You have to think about global market.
They know very well Bitpanda and whatever, purely European players.
And Bybit hack happened.
So Bybit hack.
But that's an
Bybit
Asian exchange.
Was preventable.
Yeah.
And Bybit hack happened in Germany, right? In the end, because the safe angle was...
It doesn't matter the location.
Okay.
It doesn't matter, any of that. The only thing that matters is the technology that you're using. And if you're not using the right technology,
how is it possible such a big exchange could fail?
I mean, without going too much into the details of it, there are 3 elements that we have outlined throughout all social media that Ledger provides with the enterprise solution. These three elements are clear signing, which is we are the only one in the industry providing that. In that specific instance, the approval was made without clear signing. The second point is personal security device. I have one here.
Surprise.
Which is tax. This is our new product. So whatever you see in this display is the truth. Why? Because inside there is a secure element, which is a chip that preserves the security of the information displayed on the screen. Again,
but isn't it like a little bit uncomfortable to walk around and have that on you?
Uncomfortable in one sense.
I mean, like, I don't know, like you drop it and then, I don't know. I mean, I dropped my phone last night. I mean,
if it cost me 1.5 billion, I'll take the chance of having something uncomfortable in my pocket. I mean, your cell phone is probably like 3 times the size. So, and the third one is governance. With Ledger Enterprise, we have a governance engine that provides transparency on who has control over the assets at any given point. So these 3 elements could have prevented that. Okay. In that specific instance, they did not use that solution, and we have instances, in the past many times over. So.
But I mean, security, fully agree that is the absolute basis for everything. But what is also driving this adoption a bit is also the comfort, and I mean comfort with regards to counterparty risk, to trusted parties, and also to technical connectivity. Yeah. Because what a bank usually doesn't want to do is kick off a huge project with millions of IT costs and so on to offer something where they are sometimes not even sure if the business case is big enough internally and evolves as they have imagined. And that's why I think, for example, also with an announcement of Clearstream, the second largest CSD in Europe with 20 trillion, not billion, trillion under custody here, offering crypto going forward with the same rails, with Swift connectivity and so on that banks are used to. That is also moves like this are also quite a game changer. Yep. Because it just reduces the market entry barriers massively and gives really an easier, besides all the on top of all the security, also a bit more comfort to offer something and offer institutional custody by themselves.
Yeah. Thank you.
In general, I just want to add, I mean, it always depends on what kind of product you're offering. In our case, for example, as running exchanges, being a liquidity provider, providing custody solution is an add-on to our clients. It's not our core business, right? Yeah. So the question you raised is more concentrated on pure custody providers, actually, and what the development is there. Nevertheless, I totally agree to the aforementioned, because security is key, and the license framework is key as well. Because this is what builds trust, and the whole system actually is based on trust mainly.
Yeah, I think this relates to what I was going to say. Look, at the end of the day, the Bybit hack, it's of course a massive event. Security is, I think, the core issue, right? That's the root of the problem. But the solution is actually fairly simple. Maybe you don't want to leave tons of collateral on exchanges. Maybe there should be a segregation between exchanges and custodians. I mean, it's not like we're reinventing the wheel again. In traditional finance, we have this segregation of duties, and for a good reason, right? I think we'll see more hacks like that. An exchange actually, in a way, shouldn't even be a target, because they probably shouldn't hold client assets in the first place.
Yeah, maybe just a quick point. Also, the access needs to be controlled by the same level of security, because if the access can be compromised, then you will be exposed in any way, even if your policy and your governance is correctly done.
One little thing to add, because yes, segregation of duty, but this might as well happen also if every bank builds up an own custody solution and the whole post-trading infrastructure is completely scattered. And that's what is happening now. And I don't know if it's healthy, and I'm not saying this because we are owned 100% by Deutsche Börse and we have a central CSD who is in the traditional world trying to actually bundle everything in one solution. I'm not saying that this is the end solution for the crypto market, but how it's happening at the moment on the post-trading infrastructure in the crypto space, I mean, that's just not efficient and not a long-term solution. Yeah? And if every bank has their own custody solution and you do even have trading somewhere else, but still then 25 custodians in Germany have to settle with each other, it just doesn't make sense. It's not efficient, it's not safe. You have a lot of on-chain transaction where with every on-chain transaction something like this can happen, doesn't matter if they also offer trading or not. So I think that's a bit the task for the next years actually to make the post-trade infrastructure in Europe or actually worldwide, globally a bit more efficient, and that means having some streamlined settlement solutions that also set some standards, because that's absolutely not the case at the moment still. And one thing you mentioned also insurances, if that was, I think you asked for insurances, if they also actually brought institutions enter the market, I would clearly say no here, because the institutional market is still not good and not there. I mean, everyone has an insurance, and that's also good, and it also covers something and so on, but the insurance market for crypto is not really good at the moment globally.
So that's still in kindergarten level?
Yeah.
Okay, thank you. Okay, we have 14 minutes left. Nice, okay, so now we are it's March 2025. Some of you have been here with your products for 5 years, 10 years, well, different seniority here in terms of companies. But if you had to build an institutional grade crypto product right now, what would be one of the things you would change? Because you've seen things that could have been better from day one today.
I can start.
Yeah.
I wouldn't change anything in terms of
Nothing.
execution. So we focus on security, we focus on UX UI. That's the product, right? People needs to know how to use the product, and people needs to be secure using the product. So that would not change. I would start the institutional much earlier. So the timing is what could have changed. I mean,
Timing how?
in retrospect, you couldn't, because there is, you need time to develop things. But we could have prevented things that happen, if we would have had these products earlier. But it comes with the maturity of the market.
I didn't get, what do you mean about timing? In what sense?
In a sense, when you start developing certain products, right?
So you would have started
Much earlier.
how?
Instead of 2 years ago, maybe 3 or 4
But you're starting today.
Sorry?
You're starting today. So what would you change today? You can say to start earlier because you're starting today.
I mean, from the development of products, I think, is the right approach, because otherwise we wouldn't have the response from the market. So we're measuring based on that. I think, maybe education is something that should be done more. So not the development of the product itself, like making people understanding deeply what are the implications of not having the right level of security or not having the right product for security.
But if
And
you see
even,
the product,
even there, we've done like significant work. So,
but before we were talking about, there's still some European banks, for example, where maybe you have a board member that's still like, no, we're not going to do anything with crypto yet. So security doesn't matter. How are we going to convince that person today? It's not a security question, isn't it? Isn't it maybe they see more like something dodgy?
well, it's one aspect, right? Like, so if you still see like hacking happen constantly, it definitely doesn't build the trust. So that is one aspect, but that's where we can help from technology perspective. That's what we serve, right? So we cannot help in any other way from our standpoint.
So starting with security and customer experience, that's the basis for every product, right? Then you move on with a license portfolio, because you need to be global in this market. The market is too small to be only in one region, I said that before. And then you need to have a combination of services.
What's a license portfolio?
Multiple licenses across the world, different jurisdictions. Yep. And then you need also product portfolio, because we see how like the big banks who are like running everything in finance in the world, they also offer everything you can get, from retail deposits over trading, over whatever. Everything is offered by one player. So in crypto, that means you also need to have a portfolio of services that starts with custody, trading, Web3 access, stablecoin infrastructure, whatever. All those things you need to combine ideally to serve your customers in all their aspects, because they don't want to switch between different providers with different aspects. That's why in the end, you need to be a full-fledged solution provider for everything around this financial service.
I think the answer is completely different if you really target retail or institutional. But me talking more for
For
the
institutions.
For institution, yes. But I mean, for myself, I would say I wouldn't change in general the strategy or something, but it's really important to really have the right sequence of things you take care of. And a lot of companies really underestimate some things that take way longer in the crypto space than in the traditional space. I'm always making this easy example, but getting a bank account as a crypto company, I mean, good luck with that. That takes sometimes a good year to even open up a bank account, huh? And some people don't take this into account. So I think there are certain things, if I would start over now, which I would prioritize at the beginning. The other boring topic is also the license topic. Licenses always take way longer than expected. And if you start a bit late, I mean, we sometimes have some crypto startups coming to us, and they have built their whole app. Everything nice, everything cool, and then they ask, so how can we start it? And when we ask, okay, how do you think about the license part? They even haven't thought about it and want to go live in 2 months. So obviously completely wrong planning. Yeah. So there are certain things you have to really prioritize at the beginning because they just take much longer than expected. Regulation being one of them. And when I say it's completely different for the retail space. Now it changes a bit because now you have to have a license here. There's no way around this anymore. But before, a lot of companies obviously started in the retail space without a proper license, just offering something and maybe also a very secure and good product. But the license was just not necessarily required. And for retailers, they still don't give about licenses. It's just a fact. And in the institutional space, it's the completely other way around. If you don't have a license, they don't even talk to you.
Yeah, I would agree on what Eric just said, and a little bit disagree on what Jörg said, because in fact preparation is key. So you should be aware of what is your key product you want to offer, and then you need the proper preparation to set it up properly within the given boundaries or within the given rules of the respective market, right? And sure. All over it comes into place, are you offering a retail product, which gives you probably a little bit more flexibility regarding where do I get my license from, like even in Europe, right? And or if I'm more targeting institutional clients, we choose in our case to go for kind of the gold standard, to choose the German license and get the German license, which is still kind of higher ranked with the institutional business compared to, for example, a Maltese license, where we see all the retail exchanges getting their European license or MiCA license now, because as correctly mentioned, the retail client doesn't care whether you have a license and if you have from which jurisdiction it is, right, issued. So nevertheless, the question per se is a tough question because we're now sitting in 2025, having given a given playing field with certain rules we have to fulfill, which was totally different to, for example, 3 years ago, 5 years ago, where we are more or less have been in a wild west situation.
Yeah, maybe just to respond to what you were mentioning before, maybe we should not push institutional investor right now to enter. It will be a natural progression as the market continue to evolve and grow, and as they start to look at the market growth and say maybe here's the right time for us to enter, and maybe as we progress organically, we have the right level of security, we have the right level of licensing, the right level of regulatory framework. So just want to make sure I address
No pushing.
I think that's actually an interesting question, right? Because you're saying the natural evolution, which I also feel actually will be the evolution. I just don't know if it's natural, right? Because crypto is the only asset class that started with retail. Crypto is built upside down. We are now in a stage where it's starting to look like the more mature asset classes, where we have, a more robust infrastructure. But the evolution, to me, is actually not very, very natural. So I think to kind of maybe summarize a lot of the points that were made, and to answer your initial question, I think if you were to build something today, then you could start with a really institutional B2B business case, and you can build for institutions. I'm complaining every day about, and I said it earlier today as well, that you have a lot of crypto-native exchanges, doing everything, custody, exchange, brokerage, everything, and it introduces a lot of risk. The truth is, and to relate to your point, Marco, when you're going after a retail business case, it doesn't matter as much. And also the infrastructure was not there for them to do otherwise. So I think maybe institutional is kind of the new era or the second wave of crypto now.
Yeah, thank you. Okay, guys, so we have 5 minutes left. We talked a lot about Mika, but we didn't talk about stable coins yet. Someone told me, I think today or yesterday, that currently the euro-denominated stablecoin market has right now, is it 300 million? Yeah, I think 300 million as of today. The market cap, yeah? Someone knows? Nobody knows? Okay, it's still very small. Okay, but so with Mika, how has the dynamics changed a little bit, the stablecoin market in Europe? We have 4.5 minutes.
Not a stablecoin expert, but I can give it a shot.
Yeah.
Under Mika, so there's kind of two parts to the question, I think. There's one, the notion of euro stablecoins, as in euro, the currency, and there's also stablecoins that are regulated under Mika, which can be USD. So if you take Circle as an example, both USDC and EuroC is regulated under Mika. You're right. The market cap of these euro-denominated stablecoins is extremely small. The truth is, in Europe, it's also much trickier in the sense that Mika makes it difficult for stablecoin issuers to sort of grow at scale. There's a lot more restrictions than what you would have in other jurisdictions. For example, you need to hold at least 30% of the balances with reserve banks. So you're not getting also the same yield that you would get if you were doing what some of the other issuers are doing. But at least I think the positive thing is you're now seeing with Mika really the introduction of stablecoin into traditional market infrastructure. One element of it is using stablecoin as collateral, right? There's still kind of this big overhanging question as to whether or not stablecoins will be considered eligible collateral under regulatory frameworks like EMIR, right? So I think that there's still a lot of big questions to be answered to really see the development of stablecoins in Europe.
And in addition, I would say we're still facing the fiat on off-ramp issue in the crypto space. So the question here probably is also, is stablecoin the end solution for the fiat on off-ramp question we're all facing here? But this is probably a topic for a new round in the future to discuss that, because as long as the whole banking system, and we had that example a few minutes ago, it takes you as a crypto company up to a year to open up fiat accounts with banks. As long as this gap is still there, the stable coins are probably the ideal workaround for the crypto market to organize fiat on off-ramp.
Very, very quick answer. I think what's the main stablecoin use cases? It's payments, it's trading, it's earning yield on your treasury. Earning yield on your treasury, not in Europe, Mika doesn't allow it. So therefore we're back to payment and trading. Trading, hard to influence. Payment, to have institutions use stablecoins for payments, the licenses are a threshold to jump over, because big corporates will not start stablecoin payments in an unregulated world. So therefore, good that we have that, and we can do that, and now we need to convince the corporates to start using stablecoin payments by giving them easy solutions, which make that possible.
I have a last question I want to ask you all, just with a date note, but just quick note, yeah.
No, very short. First of all, the banking situation is getting better, luckily. So we see more and more counterparties opening up bank accounts with proper banks and trustworthy banks, and then with also the limits of SEPA Instant falling by the end of the year. It could also become actually a bit of a competitor for stablecoins here, because what is the main problem for also companies like us? The settlement, the settlement mess basically is not just for the crypto space, but it's for the crypto leg, but also for the fiat leg happening. That's where stablecoins can still add value at the moment, actually, to speed up those processes. However, institutional adoption, when we talk to banks and so on, they always want to offer Bitcoin, Ethereum first, no stablecoin. Yeah, so we don't see at the moment, and maybe Mika changes this a bit because they bring more trust in the market on the very few stablecoins that they then will be regulated. But it remains to be seen if the institutional adoption will really be there in a year from now.
Okay, now thank you so much. Amazing, thank you. Just quick question. So we talk about institutional grade crypto products, right? I said before, maybe right now we are moving from like kindergarten to preschool, but just a year, when do you expect the institutional crypto products space to be on a university level? What year, Eric?
I would say, I mean, university level would mean for me the post-trading infrastructure is cleaned up, and I would say 3 years minimum. It's getting way better, I think, within a year, but 3 years minimum.
2028.
Yeah. So, a bit earlier, hopefully.
Theodore.
Yeah, I'd say 2030.
2030?
For me, one of the big missing pieces is still the old post-trade piece that we have in traditional financial markets, things like 24/7 clearing, things like that. That's still a few years away, in my opinion.
28, 2030?
2030, yeah.
Jörg, what? 2030. 2032?
2 years.
2027? 27? Yeah.
28.
2028. Fantastic. Thank you so much, guys. And thank you to the audience.